Capital Flows panel. I'm pleased to have with me today Kimberly Adams, Managing Director and Head of Alternative Platforms at Clarion, Manraj Singh, Global Head of Real Estate Products at Nuveen, and Tommy Brown, Partner at LGT. And I think I just want to start out with maybe having each of you just give some perspective in terms of your businesses, where you sit at your businesses and what you individually do. So maybe we'll start with you, Kim.
Sure. Good morning, Kim Adams. I am part of the leadership team at Clarion Partners. We're a $75 billion real estate investment manager. We invest across all product types and serve clients internationally as well as domestically, largely U.S. public and private pension plans. I have been in the real estate industry for 30 years. Prior to joining Clarion, I was at JP Morgan for 22 years, and for the last 10 of those oversaw JP Morgan's flagship Odyssey Fund. So what I bring to the discussion today is really some perspective on how we've watched flows change into real estate, the exciting aspects of investing in real estate today, as well as some of the challenges that real estate faces as an asset class relative to other asset classes in private markets in an asset allocation model. And then we're going to talk a little bit today about shifting capital flows and where the interest really lies relative to supply and demand fundamentals, particularly in choosing sectors. So part of my remit at Clarion is the emergence of an enhancement of our alternatives business, so real estate alternatives. I think Chad and Tom touched on that, but it's all about, outside of the big four, what is interesting today in the landscape in terms of other real estate asset classes.
Manraj?
Hi, everyone. I'm Manraj Singh. I lead real estate product at Nuveen Real Estate, and really heavily involved in sort of our growth strategy and capital formation efforts. Just a bit of background about Nuveen Real Estate. We're a $140 billion global asset manager, really across every property type and risk profile, equity and debt. The way we've organized our business is really a sector specialist model, right? So we have folks, investment teams that are organized by property type, whether it's multifamily, industrial, retail, alternatives, debt, et cetera. We have sector specialists that are focused on just that one property type day in, day out, from an acquisitions, asset management, capital markets, leasing, development, et cetera, across the food chain perspective. Our investors are global in nature, from the largest institutions to your AIs in the wealth channel. And our distribution network is global as well. We have sales teams across the globe, as well as a specialist sales model. We sit in a larger Nuveen ecosystem. Nuveen is a sort of multi-asset manager, $1.2 trillion under management, and we work closely with our friends across the aisle. And we're ultimately owned by TIAA, which is one of the largest insurance companies in the United States. So super excited about the panel and looking forward to sharing some thoughts with you guys.
Thank you. Tommy?
Thank you, Walter. Good morning, everybody. Good to be here. My name is Tommy Brown. I'm a partner at LGT Capital Partners. LGT is an alternative investment management business headquartered out of Switzerland with roughly 110 billion of AUM across alternatives. In our private markets, we're investing via funds, secondary interest in funds, and then directly in deals in each one of our private market verticals. In real estate, we're investing globally, and I would say that's half US, half Europe, a little bit of Asia, and we are, I would say, half funds, half directs in any format. And we have different pools of capital. We're largely drawing from international investors and largely investing out of evergreen vehicles. And so from an investment perspective, we look at the world, I would say, in sort of a value add type return, but we look at things on a net after tax basis, and we also look at it depending on duration.
Great. Thank you very much. So I'm in the capital raising business, and it's been hard the last few years. I mean, really, really hard. And As the JP Morgan panel showed, a lot of people have had some decreases in their portfolios. And then you layer on kind of uncertainty. And throughout my career, whenever there's uncertainty, it always creates an issue in terms of additional capital flows and how they accelerate. We had a good start to the year, but now we've got a few things that are starting to happen from the macro perspective, and I want to touch on those. So obviously last week, Iran, Venezuela, tariffs last year, polarization of our U.S. Electorate, where compromise seems far away from being a possibility. And there's plenty of other issues that are known and unknown that are going to be happening. As each of you think about your portfolios and the macro shocks and macro things going to be happening, how do you filter that into your decision making at your organizations? And maybe Kim, will start with you.
Sure. I think when you think about back to Chad and Tom's presentation, you look back 5 years ago and you think about how much has changed. You could say the same thing in the current environment week to week. So there is constant change on the geopolitical front and on the macro front. I think one theme that we anchor to as investors is demographics. There's a lot that's unforeseen on the landscape, but one thing we know for sure is how many people are turning 45 in the next year and how many people are turning 80. And the surety around those US demographics is really bubbling up some high-level themes that are highly investable today in real estate in general. So as we, as an organization, think about what the key drivers are in terms of thematic investment going forward, demographics rises to the top. And I would just kind of take a step back. You know, there are two particular population cohorts that we look at, and that is the millennials that are aging into household formation years, and the boomers. There are 10,000 people a day turning 80. Their real estate needs are massive and really unprecedented in terms of the size of these population cohorts. So demographics is something that we anchor to in this great sort of context of constant change.
And is that when things are happening in terms of war or other macro issues like those shocks, what are you hearing from your LPs? How do they say, how are you going to filter this into your decision making?
Well, I think it's our job as investors to really understand the short-term impacts and the long-term impacts. And I think much of what is happening around uncertainty presents itself in terms of metrics, valuation metrics. So it's not a question of how do the drivers necessarily change, but what is the risk premium today for real estate as a whole, for those sectors on a relative basis, et cetera.
Thank you.
Well, if I can answer that maybe from a different perspective, which is, I would say from a non-US perspective, looking into the US, there is concern about all of the noise, the chaos. And I think people have become a little bit numb to it, frankly, and you've seen how markets have reacted the last 7 days. When we talk to people from a non-US perspective, I think the bigger concern is interest rates and whether or not there's intervention in setting interest rate policies, because then that potentially leads to more of an inflationary environment that's maybe harder to control. And so a lot of the other noise, I think people can get through, or they're digesting it. It's really, when it comes down to a fundamentals perspective, I think you're right, though, Kim, when people think about the US, there's certainly you can articulate a much stronger case of why investing in the US now and why investing in real estate. And I think if you can get through all the noise and get through sort of the interest rates, then you can get to the real estate discussion.
Okay, I think some of this also becomes very personal, right? And we went through this cycle for 12 months or so where, you know, we had the tariff situation maybe a year ago, and look, we're talking to LPs across the world. And whether it's tariffs or Greenland or war, you know, folks have very visceral reactions to the way that maybe the U.S. conducts itself. What we've seen, though, is much of this is fairly short-lived, right? You can't avoid investing in the U.S. for a prolonged period of time. especially if you're a large LP, diversified LP, this is where the growth is. This is the most liquid market. And so you could have a reaction where you're not investing in the U.S. because you're not in line with maybe perhaps how our president views the world, right? But we viewed that to be fairly short-lived. There was a period of time, 2 quarters early last year, where we did see a slowdown in European capital coming to the U.S., Canadian capital coming into the U.S., but that started to shift in the last 2 quarters of last year. It feels like we're back in business. I mean, we've had capital come in from all sorts of places across the world, and it feels like folks are sort of getting back in line. But to your point, every time there is a sort of a geographic or a geopolitical issue, you kind of come back to that same conversation again, right, around is this still investable?
I had a conversation with a former CIO of one of the big Canadian pension plans last year after Liberation Day, and he said, look, Walter, this is kind of like a hockey game, right? There's a fight that's going to happen. We know we're going to get our asses kicked, but we're going to throw some punches and knock some teeth out before it happens. So, the Canadians need to put money in the U.S. They were obviously very unhappy about what was happening with some of the commentary and the tariffs. Tommy, you're in a good seat about this because I know you're part of AFIRE and you have a lot of discussions with European investors on a regular basis. What's been the mood amongst that group about investing in the U.S.?
I think there is concern. And I would agree with you. The last year, there was much more of a visceral reaction. The first part of the year, people have lightened up. Walter, I think the question that people come back with, when you're sitting far away and you hear the headline news, you're outside of the bottle looking in, there's a whole list of things that do and are concerning. The first question is autocracy and rule of law, and will my investments be protected with government intervention that you started to see? I think the flip side of it is that when anyone gets on a plane and comes here, it's business as usual, and people want to realize that they should be putting money. But I think again you have to counterbalance that with the new ESTA requirements. If it requires the 5 years of every social media account and email and telephone number, I've had many people say, I'm not coming to the U.S. So there's a push and pull, but I think I come back to it, people do realize that they need to be here.
Yeah, and the good news is that the uncertainty impact is not specific to real estate. We're facing this across all asset classes, and uncertainty makes investors nervous, and we as investors look for opportunity in those moments of uncertainty, but it's not specific to real estate.
Maybe just shifting gears a little bit, in the prior panel had the graph that showed the balloons or the bubbles showing real estate and how it's a diversifier. I'd like to maybe hear from our panelists about how you think about real estate for your portfolios. What's the main purpose for it? Has that been evolving? How is that changing? And maybe start with you, Kim.
Sure. It's a diversifier, and there's also an opportunity to generate alpha as we watch NOI growth potential in specific sectors. I think the reality is that real estate has been a, quote, harder sell within the asset allocation model over the last few years. We were, as an asset class, often viewed as a proxy for fixed income when we had a 5% income yield and some appreciation, and the rise in interest rates has changed that. The second thing I would say is that real estate performed relatively well over the last decade, so there's a level of robustness in terms of the allocation in portfolios of our clients, meaning they don't necessarily need more because they've already kind of reached their allocation targets. The equities market and its performance has also, from a denominator effect perspective, supported that. So it feels a little bit like musical chairs within that same allocation, whereas, for 20 years, we've watched the real estate allocation and an asset allocation model grow. That's a different set of guardrails and a different opportunity set for us as investment managers as we think about real estate.
Thank you.
We've had maybe 5 or 6 quarters here now. I mean, like this is a data-driven conversation. We've had 5 or 6 quarters of positive total return, right? And if you look globally, 21 out of the 21 major MSCI geographies have resulted in a positive total return, even as recent as the third quarter of last year. We feel like we deserve to be back in the conversation as sort of real estate allocators or general allocators broadly. But I think the way that you interact with large LPs has started to change a little bit. I think in the last 4 or 5 years where maybe real estate capital raising has been taking a bit of a bath, you have new entrants in the market like private capital. I mean, we're a diversified shop, and so we have a large private credit business, rather. And they've been enjoying a sort of golden years. Same thing on infrastructure equity. I think folks are looking at private credit and infrastructure equity. You guys have probably seen the same. And we walk into a room over the last 2 or 3 years, that's what we're being comped against, right? That's what we're being compared against because that's their sort of real assets allocation. So what we found to be effective, especially coming into the last couple of quarters, is find ways to partner with those other asset classes and sell as a single unit. And maybe this is sort of a Nuveen philosophy given sort of the way that we're constructed or built out. But it does feel like that conversation around real estate is not just a pure real estate conversation, right? It's sort of how does this fit in to everything else that I'm doing with you? And can you give me fixed income and equity and alts broadly in conjunction with real estate all in the same sort of allocation? I think that's been a conversation that's been a little bit different than your pure play real estate discussions over the last couple of years.
And I think part of that issue is that if you look back the last 10 years, what headwinds have we had in real estate? We've had secular shifts in office, we've had secular shifts in retail. CIOs look at their real estate book and say, look, the last 10 years, and by the way, interest rates. And so the last 10 years, you've had a lot of headwinds, and I haven't gotten any money back. And so there's the bigger issue in terms of people sitting in their funds portfolio and looking at going, I've got to go back to 2013 or 14 as a composite to get to a 1 DPI. And so there's I think a broader, more systematic issue in the funds world that people aren't getting money back, and so they're reluctant to put new money to work. So our conveyor belt of core buying, value add, and opportunistic is a little bit broken because today people don't want to put money into core because they're going to put it in private credit. So we can articulate, I think, as practitioners, why now is a good time to invest in real estate, but we've got to convince people to actually give the money to sort of reset that capital flow cycle.
Or have the money to do it, so they know where they want to put those go-forward marginal dollars. It's just a question of having the liquidity to do it.
Great, excellent. Maybe just shifting gears a little bit in terms of sources of capital, and this is probably more for Kim and Manraj. 20 years ago, you had to do a roadshow for a fund. You got to all the major state capitals, the pension plans, the endowments, insurance companies. A lot of those investors have more mature portfolios now where they've got their group of managers that they like. It's hard for a new entrant to kind of get on their platform. And there's been an increasing evolution in terms of newer spots to go for capital, including high net worth and RIA capital. What are your folks doing in terms of some of those other channels of capital beyond the kind of the traditional pension and endowment and regular PRIA type investors? And Tommy, if you've got comments, you can join in on this too.
I'm happy to start. I mean, look, the institutions are still a major focus for us, right? And yes, more institutions are looking to do more with less managers, and that's an evolution across the board, not just in real estate. But I think there are 3 really interesting, call it newer avenues that we're very focused on this year, and you're probably going to be hearing a ton about it, right? One is retirement, insurance, and wealth broadly. And on the retirement side, I mean, you guys probably heard of all these sort of federal programs or sort of message around electrifying 401k plans with private equity. And like for the folks in the room here on the real estate side that have been a part of some of these industry organizations for years, like DCREC and Decolta, I mean, we are primed to participate in this next phase of growth. And we've been talking about it for years, right? This sort of evolution of DB to DC capital. We're starting to see that in real time. And DC Capital, right now I think is allocated roughly 1% to real estate, right? There's a massive opportunity there. And there's this newer sort of age of retirement programs called the Pooled Employer Program. If you guys haven't heard of it, you will this year. And these PEP programs are essentially an amalgamation of smaller to mid-level corporations that may not have their own sort of institutional retirement solutions. And so they pool together under a single plan sponsor and a single fiduciary, and real estate is becoming a large portion of those PEP programs. And that market's grown from maybe $10 billion 4 or 5 years ago to over $25 billion today. And we participate in some of those, and it's a nice monthly check in the mail to sort of grow your fund and be able to deploy real estate. And what's interesting there is you need to have the right structure to be able to access that market. And so, there's been a huge growth in the CIT space, or the collective investment trust space, which essentially is a wrapper around your institutional vehicle that makes it eligible to be invested in by retirement plans. And that involves daily valuations, it involves more regular liquidity and having conversations around liquidity with the plan sponsor.
CIT stands for what again?
Collective investment trust.
Okay.
And you've probably heard in the news, and over the last couple of days, there are some large brands that are coming out with massive CIT programs, and that's not going away this year. It's going to be a theme. And so I think it's important to be able to access that market with the right wrappers, right? Because those folks are looking for something a little bit different. And the great thing is it can plug into your standard institutional vehicles that exist already. And so you have this great confluence where retirees can invest alongside institutions, right, in the same assets. And so you're also being able to sort of preserve your pipeline. I think insurance is an interesting space, right? We are an insurance company, or owned by an insurance company, and the things that insurance companies are looking for from an RBC optimization perspective, or an NAIC rating optimization perspective, it's a little bit different than your standard pension. And I think we've been approaching them in a way that we've approached all of our investors to date. But there are some interesting new structures out there, call it your collateralized fund obligations or rated note feeders, that you take your standard fund allocation, but you transformed it into these bond-like instruments for insurance companies to invest in your funds. And we view that to be a growing space, and a space that we're really excited about. And ultimately, wealth, right? It still feels like we're in the early innings of wealth. I mean, you started to see a lot of the non-traded REITs in the market start to show positive sort of net flows, right? I mean, we saw some large brands in the last month or so show the same. And there's opportunity here in the U.S., not only in the non-traded REIT space, but in the other semi-liquids. And it feels like internationally, we still are scratching the surface of what you can do. And there's a lot of folks setting up Australian unit trusts to access the Australian markets, growing dramatically from a wealth perspective. So it's exciting to see where this goes. And from the wealth perspective, we're largely playing in the core plus space, right? And we have yet to see value-add vehicles make it into that space outside of just access funds. And so I think that's another theme that folks are really excited to see how that plays out.
And at Nuveen, you're in a very good position because you got brand, right? So having a good brand is probably really important for those kinds of investor channels.
Yeah, absolutely, and especially on the wealth side. And look, internationally, you have to do things to grow your brand. We have a brand here in the U.S. and we're growing that internationally. And if you want to access that capital, you may have to do things that are a bit organic to get there, or inorganic to get there.
But Walter, what I think is interesting about this whole discussion is that you're spot on with all of those channels. But the question is, who can access that? And I think you'll continue to see this bifurcation of larger players and the rest of the world. And if you look at capital that was raised last year, the top 5 funds raised like 30% plus of the capital. And so you'll, I think, continue to see the haves and the have-nots in sort of real estate fundraising.
I think that's right, and it's also the impetus for a lot of the M&A that we're seeing across the landscape. It's just, at some point, without scale and distribution, it's just very difficult to compete, which we've known for a long time. But even these sharpshooters that can demonstrate strong performance, at some point, if the goal is consistent scale and growth, it's really hard to do without distribution, because people want to do less with more. So brand matters and scale matters.
So maybe just diving into structure a little bit more, maybe just some thoughts on the open-end fund structure. And Kim, I know you've got some perspective here.
Yeah, it's been a challenge in terms of the real estate landscape. I think Odyssey's exit queue is still slightly above 10% today, and it's been several years, and investors have expressed a level of frustration. I would say a couple of things. The first is that open-end funds, in terms of their structure, are still very sound. It is really never was intended to be an ATM. It was always reflective of the liquidity of the asset class that sits within it. So that's first and foremost. Second of all, open-end fund managers are consistently balancing the performance of the existing investors relative to the liquidity needs of the exit investors and all of the investors. So it's a tough job. I think that as much as we would, and I would say, this cycle in terms of liquidity has lasted much longer, which partly goes back to what I articulated a little while ago, in that asset allocation hasn't grown in terms of real estate. So when you think about 08 and 09, when we had these large queues in real estate, it was big exit, values dropped very quickly, and it was a buying opportunity, but real estate allocations were close to 5 to 7%, not 12 to 14%. And so the money flowed in, the queues lasted relatively short, and we saw those quick flows go back. The other thing I would say is the number of open-end funds that you could invest in out of the GFC were 10% of what exists today. We've got a huge core index today. We've got 90 plus open-end core funds. There's just a lot of different places those dollars can go, and so even if you're garnering your fair share of the market flows, the flows are minimized and a lot more people are competing for those flows. The truth is, I think that the open-end model is still sound, it still works, it's just faced some challenges that it's coming through, and I think it's difficult to say what could replace something like that, particularly when core and core plus is the ballast of many of these clients' real estate portfolios.
It feels like it's been a frustrating conversation. We also manage a series of open-ended funds, and it's not just on the open-ended side. Maybe on the closed-end fund side,
That's right.
you're in these extend and pretend. Just taking a sort of a note out of the Debt Friends book, right? Like, if you're in 2023 and your fund term is up, you're going to want to extend that from a fiduciary perspective. On the open-ended side, you have a redemption queue. You may have a massive commitment queue as well. And so you have maybe two and a half different ways to generate liquidity. Either you can match redemptions and commitments, you can sell assets, or you can borrow to fulfill redemptions, right? And the third one is not very often used. And so if you feel like as a fiduciary valuations are dropping and will continue to drop, you cannot as a fiduciary sit there and match commitments and redemptions if you are fortunate enough to have an entrance queue. Right? And you're not obviously in position to sell your assets because from a fiduciary perspective, it's not the right time to sell. And so it does create this sort of logjam that, we understand structurally why it works that way, but from an LP perspective, we do get a lot of frustration. And so what we've seen as a sort of a theme over the last, call it 2 or 3 years, and maybe you guys have seen the same, is investors that have the wherewithal to deploy into real estate and they have hundreds of millions of dollars to do that. They can't go into an open-ended fund. They can't go into a closed-ended fund because you haven't gotten your capital back yet. And so they are enlisting SMAs in large quantities across the board. And it used to be like, you used to get an arbitrage opportunity for an LP to sort of create this large account with a GP. But really, it feels and functions like a closed-end fund. Your economics are in line with closed-end vehicles now. You have discretion on the buy, but what the investor now has control over is they get to dictate when they need to sell. right? And regardless of fiduciary obligations, there may be something that the LP needs to solve for that they may be willing to take some loss on to sell. And it gives them a sense of control. And you know, you probably see a similar trend in the co-investment space, right? Investors are looking to do sharpshooter co-investments now, large deals, because they can touch and feel and underwrite the deal. And depending on how you've structured the deal, they may have some level of say or discretion in the sale, right? And so again, it feels like because the folks that are deploying capital are being much more discerning around the structures that they're coming into, and because they're coming in with large dollars, they do have influence given the lack of flows back into the traditional fund space.
Right, that's not an option for everybody, obviously. Tommy, maybe, I know you allocate to funds, and do you allocate to open-end funds ever?
We have, we've done one, Walter, and we probably may not do another one. But that's a question of our portfolio construction. You know, what I would add to this conversation, though, is maybe to take the proverbial step back, because you know, if you've been through real estate cycles, now's not a bad time to be in real estate. You know, we don't have leverage issues, we don't have oversupply issues, we have pockets. You know, from a macro perspective, real estate's a good place to be right now. I think the broader issue that we have, we're talking structural changes in how capital flows work. I think from a CIO perspective, they look at that and say, your core real estate's priced at 5%. I can get that in other alternatives, in other asset classes. And so I think for us as practitioners, you know, we need to continue to articulate the case of why people need to be in real estate. I think it's a fundamental question of what's the role of real estate in someone's portfolio. And for many years, we've been selling, you know, the private equity alternative, which for the last 10 years hadn't necessarily delivered. And so I think as we talk about real estate here and talk about these changing capital flows, it's making sure that we position it appropriately. And to that point, you know, the core plus and core play certainly makes sense. It's just a question of, again, coming back, what can people do in their portfolios today?
Maybe shifting to closed-end funds, and this is for you, Tommy. What do you think the future of the closed-end fund business is?
I'll answer it like this, Walter. I think a large part of the industry can't do anything but funds. And so to a large degree, institutional investors are going to be structurally, just from their back office, from their CIO, from their staff mentality, they can't do anything but funds. I think there's a broader question of, you know, you and I have had this conversation, does the world need another fund manager? And you know, there's, 1,000 funds in the market looking for capital. And I think the way that we look at it today is the entry level for admittance is much higher, because what I think everyone's realized is that these are not 3 to 5 year relationships. They turn into 7 to 10 year relationships. And so you're underwriting a marriage with someone as to whether or not only will that team be there, but will the platform be there? And in this current cycle, I think there are many zombie funds that are, you know, not going to be here in the next cycle.
Yeah, I mean, there's managers out there who they're at the end of their fund life. They're not selling assets because they want to keep the fees going so they can keep their team together in the hope that they can raise money in the next couple of years. So there's a shakeout that's going to happen with some of those groups. You agree? Yeah. Any comments on closed-end funds from Manraj or from Kim?
I think it covers it pretty well. Look, launching a fund one right now is probably one of the most challenging things you can do in the real estate capital raising space. And we have a few vehicles that we're launching that are first-time vintages. And without, we're fortunate enough that we have a general account where you can use sort of the general account to build a track record, right? But without a track record or a true differentiator, which is very challenging to really get access to in the real estate space, and maybe we'll talk a bit about the operator angle here, right? If you have a special sauce, that's probably how you're going to get in, right? Otherwise, it's a very challenging conversation to have with an LP to introduce a brand new manager for a single niche strategy somewhere.
Completely agree with that. Completely agree. Maybe just some discussion on secondaries and continuation vehicles. Have any of you had any experience with those, and you think that that's going to continue to accelerate?
Yeah, look, I mean, the secondary space is probably bifurcated into LP-led secondaries and GP-led secondaries, and I think maybe that some of the conversations around LP-led secondaries are a bit overblown. I mean, maybe 3 or 4 years ago, you did see some trades, or at least price talk of 8 or 10% discount to NAV trades in the secondary market. I'm not sure if they actually went through, but in recent time, we've seen a trade about a quarter and a half ago where it's a 1% discount to NAV, right? It's not a real arbitrage opportunity. And really what I think is happening there is folks are looking for access to a portfolio quickly, not necessarily a discount to NAV. I think the GP-led secondary space is a lot more interesting, and it feels more like special situations from my perspective. But it does feel like there's some of the secondaries conversations a bit overblown.
I would agree with that. I think that we thought it was going to be a big source of trade 3 or 4 years ago, particularly on the LP side, and the discounts weren't there, or there was a mismatch between the size of the trades and the discounts of the trades. There is more activity in the GP side. I would agree with that in terms of special situations, and there's some interesting opportunities there as well.
I would argue that we have a definitional problem, because when people talk about secondaries, traditional LP secondaries trades, as you would see in the private equity space, in real estate that's been cyclical and it's not as liquid. And what the industry has done is basically raised money around secondaries, and I would just call it a deal.
Right.
And
that's right.
And if you look at what that quote-unquote deal is, it's GP-led secondary, it's a recap. It's just really a question of what's the role of the seller post-close. And so there has been a lot of capital aggregated, and you can also call it special sits. And so there is a different form of opportunity fund that is called secondary. And I do think that those capital flows will continue, and you've seen capital aggregated, and I think you'll continue to see that be a part of the market.
Great. Maybe shifting gears again, I think the audience would love to hear some of the best ideas you have. How are you guys thinking about where you want to allocate capital this year and next? You run the alternatives business, so I'm assuming that some of the things you're looking at are not traditional real estate classes, but maybe just get some perspectives in terms of property types and also geographies that are most interesting.
Sure. I would say our highest conviction strategy today is really in the healthcare space. And I spoke a little bit about the demographics and those population shifts, particularly in senior housing, as we watch the aging population grow as well as watch their wealth grow. And so when we think about where to invest in that particular sector, it's really a micro-market view on what does the 80-plus population growth look like? What does their wealth look like? What is the growth of the adult children population, the adult children wealth, and then importantly, labor market, because that is a big needle mover in terms of operating margin. So I can't say enough about the strength of those demographics and kind of this needs-based care that we're seeing. Things are changing in terms of technology in healthcare, and senior living and senior housing is definitely a large opportunity. If anybody has followed the space, it's been very tumultuous over the last 10 years. 10 years ago, a lot of supply was delivered to the market, and everybody thought the 70-year-olds were ready to move into assisted living. The reality is nobody makes these decisions until they're 80. So what you saw was a massive supply wave a decade ago. Everybody was trying to lease these up. There was no demand because people wanted to stay in their homes as long as they could. And then we had a global pandemic, which obviously had higher morbidity rates, occupancies dropped, people had a hard time leasing up, these places were basically closed. You had, a complete upside down in terms of margins as it relates to the workforce that services the senior housing, and then you had a shift in interest rates. So those that were looking for a takeout and agency financing couldn't get to their leasing hurdles in order to refinance. So we've had just a giant exchange or a turnover in the space in general. Now the 70-year-olds are 80, and they are either want to make a decision or have to make a decision. So I would say in terms of investing themes, as I mentioned, demographics, and in particular, those boomers.
On the senior housing side, are you development, acquisition? How are you approaching it? Because
The last 24 months have largely been acquisition. I mean, you can really buy a core asset with a core strategy, well-leased, strong operator, at core plus returns, just given the mark-to-market opportunity. That is changing because the market is much more competitive and the capital flows have really been focused on the space. We are thinking more and more about development today in particular markets. And so I think development has become a viable execution in the last 6 months.
right. I mean, this is a theme that we've been very familiar with. We just raised a fund. It was ground-up development, first-time fund, senior housing, operationally intensive asset class, all the things we would say, tough raised, and it's sold out.
Yeah.
So, Manraj, some thoughts from you in terms of where you're spending your time?
Yeah, I mean, a lot of the similar themes. Senior housing development's been a huge focus for us for the last 3 or 4 quarters. I think we saw a broker last week, and it looks like 15% of all senior housing development starts are somehow related to Nuveen Real Estate or its operator, right? It's a place that we have a lot of conviction in, and our LPs are also looking to get into that space in a very large way. But outside of senior housing, the themes that we've seen that are most interesting and where we've been actually raising capital is retail across core plus, and value add. That's been super interesting for us, and I think that there's a segment here later in the show where we're going to be talking about that in a bit more detail. Retail's been very interesting for us. Healthcare generally has been interesting from a medical office perspective and senior housing. We're doing a lot of medical office development. We have an operator that we own. We have a ROFO on, and so that's been a great tool for us to be able to get capital in that space. Light industrial feels like it's making a comeback as well, and it feels like a lot of the qualms that folks had around tariffs are perhaps being used as a bit of an alpha generator. Outside of that, self-storage from a value-add perspective is really interesting for us. We take an approach where we're going after mom-and-pop owned assets, call it $4 or $5 million self-storage facilities that are mismanaged. We put in some CapEx, we add in technology and drive leasing. And we do that with an in-house operator as well, and aggregate a portfolio and look for some portfolio appreciation or accretion. Affordable housing is also very interesting for us. If you have the right operator that can sort of navigate Section 8, LIHTC, individual regional financing options, there's a great opportunity there. I think that the general federal backdrop is also very supportive from a tailwinds perspective. And I will say, debt generally has been very interesting for us. Value add in particular, you're coming in, if you are making the argument that valuations have stabilized and we're on an upswing here, I mean, what better place to enter that market than real estate credit? And I think over the last year or so, it's still been interesting, but we've been overshadowed by our cousins over in the private credit space, and maybe with some cracks here in that space, there's going to be a large opportunity for value-add real estate. If you're lending at 70% LTV today and valuations are going up, right, the math should be very supportive. And so that's been another space that we launched a first-time fund last year, and we were able to raise more than our target, right? And I think it just goes to show that there's a huge demand for real estate credit that still feels a little bit untapped.
I think you bring up something interesting, and I think it's important to make the distinction about really execution. You talk about in-house operators and partners and how you operate in this space. I mean, I know that JP Morgan talked a little bit about this in their session. Sector selection was the name of the game. Even in these alternative sectors, the stock picking piece of it wasn't important. You could aggregate portfolios of industrial outdoor storage as an example. Didn't matter what the credit quality looked like. It really didn't matter geographically where you were. If you owned it and you could bundle it and you could sell it in a portfolio, there was massive cap rate compression. Those days are really over in a lot of these alt sectors. Some of them are newer than others, but the reality is that they are institutionalized today. There are institutional exits that are proven in a lot of the alternative spaces. There's institutional financing today available in a lot of the alternative spaces. Really, to be excellent in these spaces, it's an eye on stock picking and execution. And that becomes critically important. So I think as LPs get smarter on these non-institutional, really, we're non-institutional, more institutional sectors, the question really they should be asking is, how are you going to generate alpha? And if the answer is 300 basis points of cap rate compression in an aggregation strategy, that's not, in my opinion, the way alpha is going to be driven going forward. So the question they should be asking is, how are you going to execute your business plan? What is your expertise as an organization? Who are your partners? How are you partnering? Do you have a captive pipeline? Those are critically important in terms of go-forward performance.
Yeah, an interesting phenomenon that we've been seeing with the LP conversations that we're having now is, they're measuring you based on your track record. That's been generally the theme that we've been seeing is, what is your track record in, senior housing? But now the conversation, because I think the operator discussion is becoming such an important part of your sell, is show us your operator track record.
That's right.
How well have you actually picked, yes, we need to pick the right assets, of course, but are you picking the right operator? And can you show us over time which operators you've picked, how well they've done, and where does that operator live? Some competitors put a lot of these operators in large opportunistic closed-end funds. And so the commercial viability of that operator to other parts of the business may be short-lived. Right? And so is that permanent capital that owns that operator, or owns that pipeline, or is it going to be sort of a 5 or 6 year time frame where you can leverage that sort of piece of your business?
Tommy, I want to hear about where you want to put money this year.
Walter, I was going to flip that around. Your comment and question earlier about funds and what's that look like going forward. What we continue to see is just hyper-specialization. And so those operators that do have, the ability to eke out incremental NOI through operational efficiency and understanding are garnering capital. And so if there is an answer in terms of, what does the funds industry look like going forward, I would say you will see that emergence of the specialist healthcare developer or what have you. In terms of the world today, Walter, I would, break out U.S., Europe, and Asia. From a U.S. perspective, I would broadly say, we can look at the world in terms of, I would put it in 3 buckets: development, credit, distress opportunities, and then everything else. And so if you have appetite for development, there's a case for, new stock. Obsolescence was always theoretical. It's real today in our careers. In terms of distress, we're still playing through and continue to see a lot of, what I call event-driven value opportunities. And there's stuff hitting the wall. And then lastly, in terms of that traditional bid-ask marketplace, I would agree with Kimberly. It's basically focusing on niches, a little bit of iOS. I would say also on the resi side, still playing and mining some themes there in certain parts of affordable. With respect to Europe, I would say U.S. on a U.S. basis. U.S. is fair value. Europe, we still consider a bit cheap. From a financing perspective, we're still able to do sub-4. You can still buy in 6s. And so you've got a very positive spread. And so frankly, we've just been focused on net lease in Europe and focusing on cash flow. And in that regard, really more on Iberia and Southern Europe, where there's a little bit more growth and a little bit more mispricing. And then lastly, in terms of Asia, what's interesting is that Asia, coming back to the secondary topic, there's a theme there of mining secondaries from all the U.S. players that went out of Asia. And so there's a lot of end-of-life funds that are cycling out in Asia where there's an opportunity.
Yeah. Really helpful. So a couple of things you guys didn't talk about, which are part of this conference, like one is data centers. So are any of you doing anything in data centers? And if not, why?
I'm happy to go first because our capital is not big enough to make a dent in any thing on the data center side. I mean, we're putting out $200 to $300 million a year. And so what do we get, half a floor? And so, so from that perspective, we've really focused on just getting our data center exposure through our REIT allocation.
Yeah, we have a sort of a captive operator that we work with for data center development specifically, and so that's where we've been focusing on. I mean, we think there's an opportunity in the next 3 to 5 years, and we are allergic to the obsolescence risk at play there, and so our view is you need to go and develop these things, lease them out, and then get out. And so that's been our focus over the last, call it 18 months.
And to do that, I mean, you need a pretty significant amount of scale. So it is not part of the current alt strategy for us as we continue to scale in alternatives in general.
Walter, what's an interesting theme there, though, is everybody's read everything and seen the amount of money being spent. And I think as real estate people, your first question is, what's my alternative use?
That's right.
And so put that aside, I think what's interesting is in this current geopolitical state, world, you continue to see nations realizing that they need to take control of their own infrastructure and their own tech infrastructure. And so if you extrapolate that by country in Europe and the rest of the world, there is a case for data center investment globally. Doesn't answer the question about the US, though.
The other thing no one mentioned is office. And a few years ago, I moderated a panel like this, and they said, who's investing in office? No one raised their hand. I said, if you got it at a good discount, would you invest in it? No one raised their hand. If you got it for free, would you invest in it? No one raised their hand. That's starting to evolve a little bit. In our seat, we're starting to hear some people who are looking for some opportunistic office buys. Or any of your organizations considering office right now?
Not from a core plus perspective, no. I think there may be some opportunistic capital out there that's looking for this. We are not playing in that space at the moment.
We are not either.
Same.
So I guess your answer is the same as it was.
If you got it for free, would you buy it?
Does the CapEx go forward free also?
Yeah.
Well, I think that's really the question. Is people look and say, what incremental dollars do I have to put in to keep my tenants?
Right. Well, what we're hearing from investors is that they're looking at it selectively in certain markets, New York being one, San Francisco being another, and then the list gets pretty short thereafter, right?
It's always a good answer. We're looking at it selectively in certain markets.
We are starting to run down in time. Maybe we'll open up for some questions if there's any. No one's got a question? Raphael, got a question? Go ahead.
Hi, good morning. Touch on tokenization of real-world assets. Tokenization?
Oh,
Oof.
great question. Did you hear the question? So who's been involved in a tokenization of real estate?
Yeah, I mean, look, from our perspective, we've taken a look at it, right? It's a lot of it is investor-driven, or a lot of it should be investor-driven, and unfortunately, our LP base is not looking for tokenization at this point, right? And we do have to deliver what our investors want. And although there is probably a really interesting opportunity there at some point for us, it's just not in sort of the LP discussion at the moment. I don't know if you guys have heard of tokenization in an institutional method.
I would break this down into two categories. One, in terms of blockchain, I think as a use case for real estate and assets, there is one. It's just a question of time to adoption. With respect to tokenization, it's just another form of securitization of equity. And so the question there is how you match that securitization with your form of real ownership and overlay that with the SEC protections and your governance protections that are afforded in your current form of ownership. And so people are slowly starting to do it, but to your point earlier about collective investment trusts and everything else, it's just a different wrapper, and it requires a completely different infrastructure in order to support it. And so people are out there starting and trying to do it. Those that have securitized, there's the famous golf course that was sold as a token, and I'm not sure how well those are doing.
I would just say that part of those new frontiers, so companies like Nuveen and Clarion, which is partially owned by Franklin Templeton, that's really where the power of these big organizations can step up, because they're looking at trends and themes like tokenization across all of their private asset classes. So we're not specifically, we as Clarion are responding to our LPs and the demand isn't there, but certainly at a parent company level, it's on the radar across all private asset classes.
Great. Other questions? Raphael?
I would ask about, you talked about how real estate competes for capital, and one of you mentioned private credit. So there's a lot of dislocation now in private credit. Does that bode well for real estate competing again?
We hope so.
Yeah, I mean, look, I think we hopefully there's a rising tide here, and we can all figure this out together. And we have our private credit friends at Nuveen that I think there's going to be certain managers that do well, and certain ones that are going to go through some pain here. But I think there is a moment in time opportunity here, like just call it headline risk, where there is going to be an opportunity for us to be able to show that real estate credit, as we've been saying this entire time, right? We are a risk-adjusted, well-protected credit asset class. And I think that sort of credit protection conversation now is going to be a key theme around how investors look to deploy their next dollar of credit.
Thank you. Other questions? There? Okay. We can talk about hospitality, hotels. Who's doing hotels?
I would say we have limited hotel exposure, and our focus has really been on the limited service segment. And then separately, an extended stay, which we look at sort of as a resi adjacent.
Yeah, it feels like a cyclical play. It's not something that we spend a ton of time on. We may have, in our general account, a hotel here or there, but it's not something that we're sort of pitching to our LPs as a interesting investment opportunity at the moment.
You're looking for certain opportunities in select markets.
Yeah, that's right.
Time for one more question, and then we got to wrap it up.
Yeah, I'd be interested in your thoughts on incentive structures for large institutional capital allocators. I work for a large national sponsor, Lincoln Property Company, talk to hundreds of institutional investors a year, and some of the smartest of those people, at least in my opinion, basically tell us that their job is to chase beta with a lag, essentially to be the last person to whatever the popular strategy is at the time, which they're basically paid as a function or judged by their performance relative to an index. So it almost guarantees a cycle of buying high and selling low, at least from an operator perspective, almost to the point where if you had a state law that forced a pension plan to deploy more when their index was deploying less, they dramatically outperform. How do you feel about kind of incentives and indexing at institutional capital providers?
Let's take that one.
There's a lot to unpack in that question.
That wasn't an easy question.
Look, I wish they did have more incentives to sort of comp themselves to some sort of index or try to outperform. You do see LPs do some strange things at times because they need to deploy large dollars and they have a relationship with someone, and perhaps the last 5 vintages of that fund underperformed, but they're still piling dollars into that vehicle, right? It perplexes me, and I think it's, to your point, probably has a lot to do with the incentive structures at those LP shops. And I would love to see a shift there, right, to perhaps a more alpha-driven approach.
But maybe the way I would think about this is that what you've seen is a couple of things. One, in terms of the preferred hurdle, that number used to be higher and it's come down, and it's a question, should that be? I think the second comment would be, as a general market comment, everyone has migrated more towards, or tried to migrate towards a higher opportunistic type fee structure in lower returning strategies. And so there hasn't been much pushback, I would say, from the institutional investment community. You know, I see debt funds that come in with sort of value add structures, and you go, you're getting overcompensated for the risk, and it's not the right structure. So I thought where you were going with your question was people are waiting later in fundraisers before making decisions, which I think that's right. People want to see sort of proof of concept and want to see assets on the ground, or see that there's actual momentum to a fundraise. And so that makes sense to me. The broader question about what fee structures are is a whole nother panel.
Great. Well, I think we got to wrap it up. So thank you very much for your time and attention. We greatly appreciate it.